So I'm going to talk about how loans work with a whole life insurance policy. First, I'll go through some basic terms, and then we'll look at an example of taking a loan from a life insurance policy and then paying it back. Let's have some fun. So as I go through these terms, the one thing I want to mention is I'm going to talk about each of these terms and how they apply specifically to policy loans. We'll begin with the cash value. Whatever you have in cash value determines the maximum amount you can borrow. For example, if you have $10,000 in cash value, you cannot borrow more than $10,000. $10,000 is going to be the max. A lot of times it's about 95% of whatever your cash value is. So if you had $10,000 in cash value, the maximum loan might be about $9,500. Your death benefit. When you take a policy loan, you will see your death benefit will be reduced dollar for dollar by the amount you take in a loan. However, if you repay that loan, you'll see that your death benefit will be restored dollar for dollar. We'll look at an example of this when we look at the illustration with a loan taken and repaid. Then we've got the policy loan. So when you take a policy loan, that money will be sent directly to your bank account. On average, it takes 2 to 3 business days from the time you request the loan until it hits your bank account. Next, we've got the loan interest. The interest is paid to the insurance company. The insurance company will also bill you for loan interest one time per year, and they'll bill you on your policy anniversary date, which is a fancy word for your premium due date. So if you're still making premium payments when that premium comes due, if you've got a loan outstanding, the insurance company is going to send you a bill for the loan interest at the same time. And then lastly, we've got loan payments. So loan payments are 100% in your control. You've got the option to pay loans at your leisure, or you can set up automatic payments if you wanted to take a disciplined approach. You could even not pay that loan back at all. You could even get away without making any loan principal payments or any loan interest payments. This is actually a common strategy we see when someone's retired and they're taking loans from their policy without any intention of paying it back. And why they're doing that is because when I take a loan against my life insurance policy, it's tax-free. That's the reason why. When you hear about using a life insurance policy to take tax-free income, it's always involving policy loans. So why do people do this? Specifically, why do they take policy loans? The main reason why is right here. Your cash value keeps on growing when loans are taken. The alternative to this is what most people do. I'm just going to pull money from my bank account or another account, and when I do that, the money stops earning interest. So an example of this would be if you have $100,000 in the bank, we'll pretend that your bank is paying you 5% interest every single year like clockwork, but you take $50,000 out. When you take that $50,000 out of your bank account, you have $50,000 left. The money that's left in your bank account is earning 5%. So with a whole life insurance policy, when you borrow that $50,000, you're still earning interest on the full $100,000. Again, we'll look at an example in a couple minutes. Now, can I just do this instead of using a whole life insurance policy? Can I just borrow from a bank? The answer is yes. You absolutely can do that. I've done that before. If you take a loan from a bank, you do pay the bank interest. But here's the thing that most people don't like, including myself. When I take a loan from a bank, there's a lot of paperwork. There's terms and conditions that are set by the bank. But here's the big thing I don't like. It takes a lot of time. That's not fun. It's nice to be able to move quickly, and a whole life insurance policy does allow you to do that. When you take a policy loan, you don't have to qualify for it or anything like that. It's very, very easy to access that money. So let's take a look at an example here, and we'll look at a popular strategy in terms of funding the policy. We'll look at someone that is going to pay into the policy just for a few years. We'll look at 5 years. And after that, they'll let that cash value just sit and grow. Meaning, after 5 years, they're not going to make any more payments. We will look at them taking loans and then repaying that loans. Let's take a look. So here we've got one page from the detailed illustration We're not going to use this because I feel like it is stereo instructions, but the data that you're going to see on Excel is pulled from this. So before we look at the loan illustration, we'll look at the illustration without any loans. So what we've got here is as follows. We see a 45-year-old male. He's paying $100,000 per year for 5 years. After 5 years, he pays nothing in forever. The total funding is $500,000, 100K times 5 years. What is highlighted in yellow here represents his break-even point, or when he gets his money back. I highlighted year 4 because we are very, very close. He's paid in 400, he has 399 and change. And then he's got his total death benefit on the far right, which is $1.8 million. And you will see eventually it begins to increase. So this is what the policy looks like if we don't take any loans at all. Now let's compare that to the same policy, but taking loans. Here we go. So on the left, you see the same thing in blue, the annual funding of 100K per year. But then you see an annual loan. We took the loan at age 50 for $300,000. Now you can take loans anytime you'd like. It can be in the first year. The earliest you can take a loan is typically 10 days, 10 business days after you start. But in this example, we took it in year 6 because we're not paying any more premiums. So just to make it simple, I'm not paying anything else. So let me see money coming out. Now, when I take that $300,000 loan, what's the impact of it? Well, before we look to the right, I would actually look over here. At year 6, before you touch it, your cash value is almost $535,000 and your death benefit is $1.8 million. What's your cash value and death benefit in the example to the right? They're reduced by how much? The cash value is just about $300,000. It's a little bit more than that because it's accounting for the loan interest the next year. But the cash value drops by about 300K. What about the death benefit? Drops by 300K. It was 1.8, now it's 1.5. Think about it from the insurance company's perspective. If we die with a loan outstanding, the insurance company is on the hook for that much less. Their first and foremost obligation is to pay life insurance claims, the death benefit. So we see what happens when we take that policy loan. Okay, what about when we repay it? So in this example, in light blue, we see how much we are paying toward the loan. We just made it a round number of $50,000. You can pay it back however you'd like. So of that $50,000 payment, in purple, we see how much is applied toward the loan principal. And then in red, we see how much is applied toward the loan interest. So of your $50,000, $33,000 in change is applied toward the loan principal, and then $16,000 in change is applied toward the loan interest. The loan balance shrinks by the amount that was applied toward the principal. So now it's worth $266. What you'll notice here is as you pay the loan back, your cash value is restored, a lot like equity in real estate that you might own. As you pay down the loan, you see more equity available. And then also what happens, look at your death benefit. It's being restored. When does he pay the loan back? Age 58 in this example. What's your cash value? $754,000. What's your death benefit? 1.8. What is that on the example to the left? 754, 1.8. The numbers are exactly the same. So again, going back to why people do this and how loans work, how they work is you keep earning dividends and interest on your entire cash value as if you never pulled money in the first place. Why people do this is because their money keeps on compounding for them. So I know it's going to continue to earn a return here, but I can pull the money and put it to work in the marketplace, whether that's my business, real estate, whatever it might be. So that is an overview of how policy loans work. The last thing I want to add here is for numbers people. Some people, including myself, like to see the numbers. So if you like numbers and you want to know if this loan is truly in your best interest from a numbers perspective, here's what I would look at. I would look at the cash value growth, specifically how much money you're getting from the insurance company every year. And then I would look at the loan interest and see how much money you're paying to the insurance company every year. I would look at this on a yearly basis, and I would also look at the total amounts. You ever have a mortgage and think, what's the total amount of interest I paid to the bank? You could do the exact same thing here. I'll show you how. We hit Control Z in Excel. We already had it prepared. So here we go. What we've got first is the yearly cash value growth and the yearly interest paid. The yearly cash value growth. This is showing exactly what you're getting from the insurance company each year. The first year, it's negative, almost $7,700. The reason why is because you paid $100,000 in, you have $92,000 in change in cash value. The difference is right here. Same thing with year two. You paid in 100, you did not get the full 100 back. You lost about 2,500. By year three, you're getting more back than what you're paying in. So here, we take the first loan in year 6, and I see I earned about $24,000. That's my total earnings from the insurance company, and I paid in loan interest $16,000 in change. So I've got a positive spread this year. That's exactly what I want. As I look at the totals to the far right, what do I see? Total cash value growth, total interest paid. Let's look at when the loan is paid off. Total interest paid, $75,000 in change. Total cash value growth at that same point in time, about $255,000. Where we got the total cash value growth from? Over here, you see you paid a total of $500,000. You have $754 and change. The difference is the $254 and change. It's all of the extra money you got from the insurance company. It's your cash value growth. But that helps in terms of looking at numbers. A lot of people like to see this really to make sure that they're not in a position where they're paying more in loan interest to the insurance company than what they're getting. So I hope you enjoyed this video. Please let us know your thoughts. If you'd like to see a video where we go into more details about policy loans and such, you can check out this video here. And as always, I hope this helps. Thanks so much.